last part of this chapter, just want to go through some of the rules for paid tax preparers and penalties for paid tax preparers. Now, these are only for paid preparers. If you're volunteering or if you're just doing a tax return for free, these don't apply. But if you are a professional and you are getting paid for preparing tax returns, then these rules do apply. This Circular 230 is one of the publications that the IRS puts out, and this is where all of these rules can be found. So the provisions of this apply to CPAs, attorneys, enrolled agents. You don't know what that is yet, but you're going to know. You're going to do some research on enrolled agents in this class. Registered tax return preparers, or any other person who for compensation prepares a tax return, provides tax advice, or practices before the IRS. So that's representing somebody. That would even maybe be a phone call, calling the IRS on behalf of somebody. If you're getting paid for it, then you have to follow the rules that are in this publication, this Circular 230. So they also tax opinions. So if you're practicing in tax and you have a client that says, hey, can you run some scenarios for me? What would happen? What would my tax situation be if, I took this other job and here's $150 to give me that opinion? That's being paid for your tax opinion. That would then fall under the Circular 230. So paid preparer is someone who for compensation prepares all or substantially all of a tax return or tax form submitted to the IRS or a claim for a refund. There are some exceptions if they do not sign the tax return, but they were supervised by a CPA, attorney, or enrolled agent. Oftentimes in CPA firms, you'll have individuals who aren't CPAs that are preparing the returns, but the return is being reviewed by somebody who is a CPA, and so it ultimately gets signed by the CPA. So that would be the individual who is subject to these rules. So in general, this is what they have to do. It's pretty specific, but this is just generally. So paid preparers, or those giving tax advice, they have to sign all the returns that they prepare, provide a copy of the returns to clients, return all original records to clients. Now you can make copies of records or scan them and have them in fact, that's what CPAs will do. Well, what tax preparers will do, they'll keep copies of everything, but you have to return the original records to clients. Exercise due diligence. Okay, that's a really vague term. That's a really vague concept, exercising due diligence. It just essentially means you have to do everything that anybody would ordinarily do to ensure accuracy of that return. So you can't just be flippant about it. You have to be professional about it, and you have to do everything. So if you should have researched whether or not that person is actually head of household and you didn't research it, that would not be exercising due diligence. So you have to, do everything within your power to make sure that it's an accurate return. Exercise best practices in preparing submissions to the IRS. So anything you submit, just make sure it's not just willy-nilly done without much thought. Disclose all non-frivolous tax positions when such disclosure is required in order to avoid penalties. So if you're taking a position that is maybe not frivolous, but out of the ordinary, you have to disclose that position to the IRS. Notify clients of any error or omission on a client tax return. Sometimes you're preparing a return and 4 months later you realize that you made a mistake on something. You're reviewing, they come in and want you to do some tax planning. So you look at their old return and you're like, oh my gosh, I forgot to enter their mortgage interest or on their second mortgage. You have to immediately correct that and notify the client. Now, you would ordinarily, under the best practices, you would correct that return and you wouldn't charge the client for any corrected return, any amended return. provide records and information requested by the IRS unless that is privileged information. So there are certain instances where information, they'd have to have a subpoena in order to get it. But if they don't need a subpoena, you provide records that the IRS requests. Inform a client if the client made an error in a document submitted to the IRS. So if you notice that mortgage interest, well, the reason you didn't include it is because the client forgot to give you the form for it, you have to inform the client immediately that they forgot that information. Also, things that they cannot do. Take a tax position unless there is a realistic possibility of the position being sustained. So you can't be frivolous about your positions, your tax positions. So if you know that the mileage rate, the federal mileage rate is 70 cents a mile, but you claim on the tax return 80 cents a mile, that would be, there would be no realistic possibility that that would be upheld if it were to be challenged. And so you cannot take that position. You cannot charge a fee contingent on the outcome of the return or any position except in limited circumstances. This means that you cannot say, my fee is going to be 10% of your refund. Can't charge a fee like that. Because what that does then is it motivates the preparer to generate a refund, and a bigger refund than maybe the client is entitled to. So you can't charge a fee contingent on the outcome, or say, I won't charge you, I only charge if you get a refund. Can't do that. You cannot charge an unconscionable fee. That's pretty vague, what unconscionable is, and would probably depend upon the geographic area that you're in, right? Charging $1,000 for just a W-2 return in Des Moines, Iowa would probably be unconscionable. It might not be unconscionable in Chicago or New York. You know, it's pretty vague. You can't unreasonably delay the prompt disposition of any matter before the IRS, so you can't just keep putting the IRS off on stuff. You can't represent a client before the IRS if the representation involves a conflict of interest. And you can't make fraudulent, false fraudulent, or coercive statements or claims, or make misleading or deceptive statements or claims. So this has to do with advertising or marketing for the most part. Let's see. So there are penalties. If a paid preparer takes an unreasonable tax position, they are subject to a penalty of $1,000 or 50% of the tax preparer's income that they received in order to prepare the return, whichever is larger. If the preparer uses willful or reckless conduct to prepare the return, the penalty is $5,000 or 75% of the income from preparing the return, whichever is larger. So that's the preparer. Taxpayer may have other penalties, but that's the preparer penalties. $60 for, what is this? So under other penalties are generally $60 for each instance. Some include failure to furnish a copy of the return to the taxpayer, failure to sign the return, failure to furnish a P-10. I don't even know how you could file a tax return without a P-10. They're required in order to e-file a return. Penalties of $635 if the preparer negotiates a refund check or is not diligent to determine taxpayer eligibility for certain tax benefits, including education credits, earned income credit, or any dependent credit. So there are these credits where the preparer has to exercise due diligence, and they have to do it in writing by verifying certain information. And if they don't do that, they can be fined up to $635 per instance for not doing that, even if the individual was entitled to the credit. The preparer could still get a penalty for not following. And these are credits that are, remember, I think I had talked a little bit about the difference between refundable credits and non-refundable credits. These are all refundable credits. They're very valuable credits, and there's a lot of fraud associated with them. So they're using the preparers as an enforcement mechanism to make sure that taxpayers are following the rules, that people aren't taking the credits who aren't entitled to them. So that's why the preparers can be fined for that. There also can be civil and criminal penalties for committing fraud, making false statements, preparing fraudulent returns, knowingly or recklessly disclose information used to prepare a tax return, or use such information for any purpose other than the preparation of a tax return. So you're collecting, I don't know, income information about clients and sharing it with unauthorized users. That as well is obviously that's fraud. And there you go. Questions about some of those